Fantastic to see so many people come out on this Tuesday afternoon for the launch of the FSC's latest piece of research on technology and micro-investing. We've got a really fun afternoon planned, so thanks for joining us. I'll get to the health and safety things, but just for everyone's edification, there's bathrooms down the corridor to the left. If you've got a mobile, feel free to turn it off. If there's any other health and safety related issues, please find your way to the exits and there'll be staff who can help you. I'm just going to introduce the chair of the Financial Services Council, Rob Flanagan, just to say a few words of open, and then we'll kind of jump into some of the content. Rob.
Thanks, Richard, and tēnā koutou, tēnā koutou, tēnā koutou katoa, and welcome all of you here today. And on behalf of the FSC board, we'd like to welcome you all and for the release of this research, which they've titled Rise of the Digital Investor, which sounds like a movie or a rebellion, something, I'm not too sure, but whatever it is, it's the future and it's very real. The research which I've had the opportunity of reading is really fascinating reading. Well, I've certainly found that it's a bit of an eye-opener of where the world is going. Also, I'd like to thank the staff of the FSC and a lot of members of the FSC who, of course, work pretty hard behind the scenes with this research, bringing it to a state where it becomes alive today. So welcome and enjoy the afternoon, and I'll hand over to Richard to start the proceedings.
That's great, thank you, Rob. Just on COVID things, there's plenty of hand sanitizer, so all of us just be safe and do the right thing. Just wanted to acknowledge and thank a few organisations, to Rob's point, who've helped put this together. First and foremost, to the team at TE. We've been research partners now for the last few years. It allows us collectively to do some really interesting stuff. Witness in a moment, you'll hear some. And certainly to the FSC Research Committee, who in fact has helped craft this entire piece of research, and in fact all the research that we do. I know there's a number of research committee reps around the room, so thanks for your collective effort. We actually started this process back in October, November last year, kind of thinking about what are the big themes we wanted to investigate, and we then crafted the question set. And so the second group of people I wanted to thank was Core Data, who's our research partner. Andrew might be here a little later on, but his team have been fantastic, and they help us go out to, in this case, over 2,000 New Zealanders to kind of understand and get onto the pulse of their issues. And the third group I wanted to thank to Matthew, to the very generous hosting of EY. This event had one email go out, and suddenly, where's Hugh, we'd already filled the room. So to SmartShares, thank you, and to EY, thank you. And the testimony of the crowd here tonight is the interest of the conversation. So thank you to all of you. I'd like to absolutely welcome Ryan Bessemer, CEO of Trustees Executors, our research partner, to say a few words. Ryan.
Thanks very much, Richard. I won't give you too many spoilers in terms of the data. But first of all, I just wanted to say thanks to the FSC and its members for allowing TE to be a sponsor for the Money and You research this year again. The information that Core Data collects and analyses as part of this exercise is so useful for us in this industry, allowing us to understand the people and the markets we serve. TE, we're a strong supporter of financial literacy. We know the ability for people to make informed decisions about their money is just so crucial. This week, we've seen the Why Money Matters initiatives come from the FSC for school children. I really do believe that things like this, we'll be looking back on years to come saying this is what we did to start building financial literacy for children to be able to manage their financial affairs in the future. Trustees executors, we've been a foundational New Zealand business for the last 140 years. This is our 140th year of operation. Actually, in July, we celebrate the birthday. So we're New Zealand's oldest continually registered business, which means that over time we've had to reinvent ourselves over and over and over again. And just like financial markets, there is change, and financial markets need to reinvent themselves. This time around at TE, through this period of reinvention, I get to run TE, and I have 25 years of financial services experience, but I actually have 30 years of technology experience. In fact, my life has been around building digital capability for businesses. First of all, in data and also in entertainment across different fields. I started my career working for a computer games company, and now I run a digital business for banks, stockbrokers, and fund managers. So what we see today in this research is the start, or what I see the very start of innovation in digitisation of investments and financial services. And you'll see some of the stats later on. While there are many factors to be taken into consideration to be cautious around these new technologies, such as privacy and regulation and security, I think these factors are outweighed very much by the benefits that these new technologies and capabilities bring to the markets that need this innovation, and to be able to drive healthy competition going forward. For many legacy players in the industry, those who cannot quickly adapt to the profound change that we're going to see over the next few years, means significant disruption for you. The burden of legacy systems and the inability to change will tip the balance of powers, and many large brands in financial services today will become the Kodaks of tomorrow. The rise of the digital investor beckons products and services, or new products and services, and it means that these new micro-investing platforms, now in the infancy, will evolve by their very nature of cloud architecture and agile frameworks, and will continue to adapt to the needs of the consumer over the next decade. COVID has been a trigger to some of this, and we'll see some stats later on, to these adoption of these new technologies. However, I think it's always had been inevitable that these technologies were coming to the market very quickly over the last couple of years. I know in my experience, as an individual, and as Wells grows, my engagement with these systems and investments continues to evolve, and we see now 90% of all New Zealanders using online systems to access banking, insurance, and KiwiSaver. But now, as part of this research, we'll see that there's now about 38.2% of the respondents now using micro-investing, or going to be using micro-investing platforms over the next 12 months. So which platforms will ultimately grow? And it will be those that keep up with the relevance and the change that needs to happen in the market. Remembering with other technologies we've seen in the past, it's not always the person who gets to the market first, but usually it's all about the ease of use and understanding. Science now has delivered a unique situation with COVID-19 medical solution very, very quickly. And I'm told that 20 times faster than any other time in history that we have now a cure or inoculation. And this just means that this sort of new post-COVID age, with us coming out and with the financial stimulus that's happened in the market, means that there's really a once-in-a-lifetime boom of many asset classes out there, and a giant wave of cash coming into financial markets. As an example, by 2026, we see KiwiSaver growing to $135 billion. So that's substantial growth. And the self-investment will drive a lot of change, and that means that industry needs to be capable of understanding these new changes to technology and investments and keeping up with those changes. Many times we see there's new technologies come along, and it takes a while for markets to catch up. Currently there are no licensing regimes for micro-investing platforms or custodial wraps. So they're unregulated really at the moment. There are regulations around them, such as advice and so forth, but what we really need to see now is not only the innovation, that's really, really important, but the consumer protection around that innovation. And as a supervisor, that's something that we'll really be looking a lot at and working with the regulatory authorities on. Additionally, most countries are still dealing with the concept of digital assets, including cryptocurrencies, non-fungible tokens. Our research shows that 21% of respondents in New Zealand are already investing in cryptocurrencies. Research last week in Australia showed that over 21% of Australians, that's 4 million Aussies over the next year, will be investing in cryptocurrencies as well. So no one wants to put a handbrake on improving experiences for consumers, but I do want to make sure that there are appropriate warnings and mechanisms in place so that the safety fences at the top of the are at the top of the mountains rather than the ambulances at the bottom. The question isn't whether there are permanent changes to financial services, but we have to realise there are permanent changes to financial services, and that these changes will continue to come and continue to evolve. And I say, bring it on.
Awesome, thank you, Ryan. So let's bring it on. Let's talk a bit about the research. So the next few minutes are going to be a bit about the research. Then we've got an all-star panel, and we're going to try and unpack some of the discussion. We are joined by many from our colleagues in the regulators. There are a number of the Fourth Estate here today, so we are completely on the record, as they say. We're also filming the entire show, so we will capture this and we will release it out to the broader membership over the next couple of days. I thought I'd just spend 1 or 2 minutes just quickly putting in context why we do what we do. And this is, if you will, for those of you who are into strategy and strategy on a page for your organisation, this is what we call our triangle of truth. And what it says at the top of our triangle is the reason why we exist, the reason why we do things that we do, which is around growing the confidence, the financial confidence and well-being for New Zealanders. So there's a direct link to the conversation today, unpacking some of the insights to ultimately help New Zealanders be better with money. This kind of conversation about money, the language of money, are recurrent themes that always turn up through the research. I won't go into any other details, and happy to pick this up through the drinks, but it kind of, if you like, resonates with why we take on the challenges that we take on. Ryan mentioned this piece around literacy, and again, goes straight to the top of that triangle, which was something we launched last week, which I didn't want to miss the opportunity because it is so new and so fresh. We're joined by many members, and including the chair of our consumer working group and committee, Clark. And one of the things we've been working on over the last 6 months is how do you actually make this conversation real? How do you actually help kids and New Zealanders have conversations about money? That's pretty cool. It's just gone out last week. Schools and kids around New Zealand are now starting to think about how they address the topic. But you can kind of see the energy from the little kids to the big kids, that conversation. For all of us who've got kids in the room or nieces and nephews, I don't know if any of us have ever had that conversation like, why does money matter? And then we all pause and go, oh, I wonder what they're going to say now. But it goes right to the heart of this next conversation, which is all about micro-investing platforms. So let me give you a sense of it. I'm not going to go through it in chapter and verse. It is going to be available, so much better that you take time to have a bit of a read. But I will just pick up some of the highlights. Again, picking up a couple of Ryan's points. So the investment landscape has seen and is seeing the rise of the digital investor. The data coming out of our research is 38% of New Zealanders are, have, or will invest in digital micro-investing platforms. When you run the numbers on the people over 18, that's about 1.5 million Kiwis. That's no longer something at the fringes. It's no longer something small. We're going to hear a little later on from the panel about why and what's been the take-up and how much has COVID absolutely changed it. So getting a fix on the number is really important. The COVID experience equally has really turbocharged that discussion. I think for all of us, we're having a water cooler conversation. I got a 19-year-old. Everyone's kind of having the chat about, did you see how much Tesla went up last night, or whatever it is. So it's kind of interesting because it does go into the heart of some of the literacy pieces. And you saw, I think it's Chris on the video, who started to talk about crypto. So if 16 and 17-year-olds are talking about crypto, you kind of know there's a conversation going on. It's how do we shape it, but also there's a bunch of risks with this stuff, which we'll talk about in a moment as well. The interesting thing then on finding number 3 is, it's pretty ubiquitous. I'm sure there are those of us in the room who remember when we first started, you got a passbook, you went into a bank branch, you had a bank chat, and you filled out forms. Like I remember that stuff, and I'm sure many of us do. I'm sure there are others in the room that go, what are you talking about? And it was, you jump on your computer and you log in. Or you can log in from anywhere in the world and do your banking. Plus you can have the chat in the banks. And now, today, it's like, this is kind of how we do banking, right? So it's this and perhaps it's not even the hole in the wall anymore because, arguably real currency is almost dead. It's completely transacted. And that, of course, is both great, but also provides a bunch of challenges. And so the challenges are twofold, and this is point 4 on this slide. The first one is around privacy. There's about 80% of New Zealanders that are seriously concerned about the risks of privacy, the risks of getting hacked, the risks of losing their data, the risks of losing their money. So there's a question about how do we manage that. The second risk that's playing through the data is that actually investment hasn't changed. Just because we're going through a snappy piece of technology doesn't mean that buying a slice of a stock that can go up, and hey, we've been in a bull market really since we came out of the real COVID crash, right? But it's only been almost a one-way traffic as interest rates have come off and people are searching for yield. But you take that conversation and you go, there's a bunch of risks, because when people see a bear market or when people see a crash, witness those kids on screen, have we actually started to prepare them for those thoughts? And I think that's a collective responsibility clearly that we've got. Again, I'm not going to go through this in a huge amount of detail, but this does give you a little bit of a sense of over 80% are now using online banking and so on. So it's pretty ubiquitous, right? But if you tread down the bottom few, the micro-investing platform is sitting at currently in green and plan to use, add those together, you're at about 38.2%. Buy now, pay later, digital wallets, smartphone apps, you can see how that's playing through. The digital currency platforms, second from the bottom, interesting. That's kind of the whole crypto discussion. And there were a number, there's been a lot of media all day, but there are a number of questions on those types of discussions, which is investing, say, through shares, is Invest Now Hatch on a managed fund or a stock, the same as buying some kind of crypto? Is it the same thing, or is it very different, or are there very different risks? And the final piece is around robo. The market here has been thinking about what role will robo have into the future. You can kind of see the current and then the intent. And so the question, I guess, for all of us in this room are, how fundamental are these changes? This is like a point-in-time insight piece, but how fundamental are these changes right now today, but certainly into the future? And, again, to Ryan's point, how much of our business models of today will necessarily need to change because we've got very different people and very different behaviours kind of coming through. We've also started to tease into the gender divide and to understand whether it's different for men or for women. Again, I'm not going to go into a whole lot of detail, but I'll just pull out the micro-investing platform as an example. So the current women 14.7%, men 18.9%, and the propensity 17.7% and 25.3%. So what's different? What's happening differently for men than for women when they think about whether it's investing in stocks via a micro platform or buying digital currencies or whatever? And does that mean we've got to nuance our message? How do we think about that as a conversation? This is kind of interesting as well. And this is about why are people flocking to micro-investing platforms? Well, when you invest, it's all about getting a better return, right? And when you can pick up whatever it is, 20 bips or 30 bips or 10 bips on a long-term term deposit, that's not overly attractive. So investing for return is important. But you can kind of see the other issues that are turning up. Financial knowledge and capabilities is starting to grow. So these platforms as almost a gateway into a literacy conversation and then into an execution conversation becomes really important. So it's not just about investing, although it obviously is about investing. It's all about the way, the journey on. The fun piece at 27.5%. I'll have the conversation with my 19-year-old and ask him, how much fun is it to play on Sharesies? But there was a period that, he was like focused and knew what time the US market opened and would wake up the next morning and all that kind of stuff. So that kind of challenging fun piece plays really neatly into the discussion. And then there's this question around growth potential. And again, what we're starting to unpack in our research is not only gender, but also demographics and also age bands. And you'll see some more stuff come through for conference about actually looking to try and track this kind of behaviour, not only men and women, but also Gen Xers and millennials and boomers and so on. So it becomes, again, really important to be able to say, do we have a fix on how New Zealand is thinking about investing? Yes, we do. Headline level, 38.2%. But now let's start to unpack how's it different for men than for women? How's it different for younger people? The data, again, pulled out. Under 39s, 55% of them are using digital online platforms, right? So if you've kind of grown up through the internet age, this stuff's like just another thing to do. If you're a little older, perhaps like my oldies are in their 80s, it's a little bit different, right? They're still going, I'm really comfortable banking online, I'm really comfortable doing other stuff online, but I'm not comfortable to do this stuff online. So that kind of gives you a bit of a flavour of it. Picking up that flavour, which is part of the third area of findings, is that age is less of a barrier for digital services. But when you unpack some of the what do we mean by digital services, a little to my earlier point, it's overweight in terms of younger under 39s versus older New Zealanders. And again, that's a question of, if we go back to my analogy of we all started life, if you're in your 50s as I am, with the passbook idea, and now it's ubiquitous. Over 80% of New Zealanders are using banking platforms and apps and so on. The question is, in 5 and 10 years' time, what's it going to look like? The other interesting thing is that when you look at the birth of these micro platforms, it's like a nanosecond, like it's 4 or 5 years. Like it's so short to get to that kind of scale. So that acceleration is just amazing. And Gus, we're going to hear from you obviously in just a moment. So looking forward to that conversation. I might just head to just then the final piece. And this picks up a little bit of my earlier comments. So 80% of New Zealanders are concerned about this privacy discussion. So the question for all of us in this room, if we're in the financial services sector, is how do you give people confidence? Because at the heart of our sector is trust. If we're going to give people confidence, how do we make sure that we manage the trust side and the fact that when you go online and you invest, you're using technology, you're sharing your information, you're sharing your details, and we're sitting in a 6-month period, a year period where some of the biggest names and brands in town, in our landscape, have had cyber issues. So, this is not about if, this is about when. And so how do you kind of manage for that? And I think there's a really, burgeoning discussion on that. On that note, folks, I'm going to say, in terms of where we head to in the future, again, a little of the themes that I've tried to craft through the discussion, is if there's a hypothesis that says where we've come from through the internet age is that people are more and more and more comfortable to do stuff online. And it started with doing your banking online, now it's on apps and so on. The last 4 years have seen a truncation of all of these things, the rise of crypto and so on. So the question is, how do we bring people on that journey? What else are we heading to? And when we look within the FSC at for examples, we're having the investment conversation, but if we were having an insurance conversation, the question would be, how can you apply some of this thinking into other product sets that are beneficial to New Zealanders? How do we harness the engagement, the educative pieces of this type of technology to help other sectors that are valuable for New Zealanders? And I think that's clearly a conversation that's been going on for quite some time. And on that note, I'm going to close the basically very high-level intro comments. I'll commend the research to you. There's lots more detail, and there's lots and lots of detail. I'd like to acknowledge the FSC team, and David in particular, who has, for the last number of years, been the writer and the creator of this both platform but also the data. And on that note, I'm going to invite our all-star panel of Rachel, Hugh, Ryan, Gus and Clarissa to join us on the panel. And we're going to have a chat. Thank you. And I didn't purposely introduce the panel because I'm actually going to invite each of the panel in turn to introduce themselves and probably just introduce who they are and kind of what's their passion point on this particular topic. We did a rehearsal on this bit. I'm not sure that we rehearsed, so I'm going to just go straight down the line, if I may. Hugh, over to you.
Why not? Why not? Well, good evening, everyone. I'm Hugh Stevens. I head up Smart Shares, New Zealand's only issuer of exchange-traded funds, and we have 35 exchange-traded funds listed on the NZX. Now, we also have a brand, Superlife, through which we provide KiwiSaver, workplace savings, and UK pension transfer services. So all up, we're I suppose a issuer looking after around 5.8 billion of New Zealanders' life savings. So I suppose you might ask, why is a product issuer up here on the panel in a conversation about distribution and digitisation? I suppose these guys have to have something to sell. So that's our job. And what they want from us, I suppose, is products that fit the need. That each of my panelists, co-panelists, is addressing a pain point for particular sections of the New Zealand market, and our products have to be relevant for those people who are investing through them. So I suppose our business has changed in response to the arrival of the self-directed platforms and also other digitalised channels, and so we've moved more in the direction of products like thematic funds with our robotics and automation fund and healthcare innovation fund, for example. But also we've had to think about, I suppose, the infrastructure that we have behind our products and how to make the products easier to invest in. We also have our own distribution and, of course, have our own digitisation challenges. And one of my passions there, I suppose, is thinking about digitisation from a real people perspective. And what I mean by that is that it's very easy to find an individual 18-year-old who's happy to use a mobile phone to access a product. But what about some of our other community members? We talk about a product for somebody. That's often not the situation we find ourselves in. How do you digitise, for example, our Kauru Ora scheme, where you might have a group of aunties who want to create funds for their, I suppose, for their nephews and nieces. Jerry has to supervise us, where we come and ask, okay, we've got a list of 16 kids' nicknames here. some approximate birthday and a request to open accounts for each of them. No one knows who's going to own the account and how do you digitise that. So I think I'd like to see digitisation work for everyone. And it's not just about vulnerable customers versus techno-savvy people. There's actually a whole raft of quite normal people who think about life differently than maybe us as an industry do. So that's my interest. Thank you.
Awesome. Thank you, Hugh. And we might tease into some of your questions. Gus, welcome.
Hello everyone, thanks for having me here tonight. I'm Gus from Sharesies. Some of you might have got an email from me this morning. I'm sorry about that. So Sharesies is a wealth...
Is the fund closed?
Pardon? Oh, yeah. We'll talk about that later. Sharesies is a long-term wealth development platform. Our purpose as a company is to create the most financially empowered generation, and I'm really passionate about our vision, which is to offer the same investment opportunity for someone with $5 as someone with $500,000. And what does the same investment opportunities mean for Sharesies? Well, it means that a generation that was priced out, jargoned out, and left out of a financial system now can have easy access, confidence to invest, and a motivation and a reason to invest. So that's how we think about problems as a company. We're Wellington based. We started 4 years ago with 6 founders. Now we're a company of 150 people, predominantly based in Wellington. We've just launched in Australia. In terms of customer base, we've got 395,000 customers here in New Zealand, and we've got our first 5,000 to 10,000 in Australia now. We offer access, 1 cent minimum purchasing of about 7,000 predominantly listed products in New Zealand, Australia, and also the US. But yeah, really happy to be here and talk more about what we see of our customer base, or how we see our investor base investing and being more and more confident in investing.
Thank you, Gus. Rachel.
Thank you. Hi, everyone. I'm Rachel Strevens, founder and CEO of Invista. So I guess I'm particularly passionate about fintech in general, and also doing what we can to help see better financial outcomes for the wider New Zealand public. I started my financial services career probably 15 years ago now as an investment advisor, and had spent many years as an AFA providing investment advice. And one thing that really quite frustrated me at the time was that there was so much of the population that we couldn't actually service on an individual basis as an investment advisor. And we were seeing some really cool things happening overseas with online investment platforms, robo-advice, these kind of things. And for me, that was really the turning point in terms of saying, well, there's some really cool things happening out there. How do we actually bring some of that down here to New Zealand? So that's when we started Invista. Invista is a B2B fintech company. We provide a range of digital innovative solutions out to other financial service providers. So we work with fund managers, KiwiSaver providers, wealth advisors, and actually help them through their digital roadmap to bring technology and sort of the latest technology and digital platform solutions out to their end customers. So we work with a number of companies across New Zealand and Australia, and really sort of passionate about what we can do in terms of bringing that digital client engagement through to the investors. How do we get them really engaged with their investments? How do we get them learning more? How do we get them advice to more products? On the company side, how do we look at sort of streamlining those back-end processes so that it's actually affordable to service a wider market, and streamlining compliance, because back in my sort of advisor days, that was one of my biggest headaches, was AML and the compliance requirements in terms of opening new accounts for people. So yeah, that's sort of my passion.
Thank you. Ryan.
Thanks. You've probably all heard enough from me, but Ryan Bessemer, I'm the CEO of Trustees. Trustees, we provide a lot of services around wealth and funds. So we're a supervisor. We also run registry and custody, unit pricing and accounting for funds and for wealth. So with all of those services, what we really do is we look after financial information. So we're a data business in a lot of ways. And the way people consuming financial services now is really digital. So a large part of our reinvention over the last few years was realising that 140-year-old business can also be a contemporary digital-driven business, because what we do is we control data. We look after assets and we look after member data. We supervise over $100 billion in funds. We are the registrar for over $40 billion in funds. We are the custodian for over $60 billion in funds. So our job is to really look after Kiwis and protect their assets. And those assets now are not only money, but data as well.
Fantastic. And lastly, last intro, Riss or Clarissa.
Thanks for your microphone, Ryan. Hi, everyone. It's great to be here. I'm Clarissa. I head up the FSC's consumer communications and projects, so like the Widest Money Matter competition that you just saw earlier. It's one of my babies. And also head up our research projects as well. So my role essentially at the FSC is to take research papers like the one that we're releasing today and turn it into engaging content that's interesting for ordinary Kiwis. And I guess more importantly, I'm also a consumer. So like Gus was saying before, you know, I'm part of that generation that has been priced out and jargoned out. So I'm offering a consumer perspective and the voice of the research today.
Fantastic. Thank you, Riss. Gus, we're going to start with you if we can, because we were talking earlier in the week just about the rise and rise, and it's now set against the context of the research. So I guess the question is, how fast has Sharesies grown as a category participant, and why New Zealanders kind of flocking to not just to Sharesies but to the online investing world?
Yeah, great question. And I've got, just turning my numbers here, I got some numbers to answer your question, then I'm going to explain the rationale behind why we think we've seen the jump. So 4 years ago, about 3.5 years ago when we started, we had 15,000 customers. That tripled to 50,000. That went 8 times to... No, so this is my phone. Sorry. We went from 15,000 to 45,000 to 150,000 to 373,000. So we've gone 3 times, and then 2.5 times. The key steps to this growth is the first step, we saw the democratisation of the space. The barrier to entry to get into ETFs was very, very low. This was all at SmartShares ETFs. The next key enabler that we saw at the beginning of last year was COVID. And what COVID provided the opportunity of time. COVID gave people time, and that gave a time to step back and get involved in this thing called investing that they hadn't had the opportunity to do before. So we were sitting there before that, but it really took the catalyst of COVID to accelerate that. We've also had a slow burn of low interest rates, so your counterfactual to investing in the stock market has become less and less returns through time, so we saw that as an accelerator through to Sharesies. In addition to this, during the COVID period, we saw a lot of business news that was coming. There's business news everywhere, and it was really easy for our customers to get engaged in the world around them, and then more people took a liking to investing, and we've seen more business news flowing through. So that's kind of 3 pieces that I've seen. We also hear a lot about property prices and about our generation, well, my generation and Riss's generation being locked out of the property market. However, we do see a lot of our investors do own property, so it doesn't seem to be the key driver of why people are coming to investing platforms like Sharesies.
That question, no, that's awesome. So that question around, we were talking the phenomenal growth. Can you kind of talk about that gender conversation that might be going on? And I don't know if you're happy to share fund size, or just broadly, how, like, is this just a bit of people's money, or is it like their whole net worth?
Sure. So what does our average customer look like? Leading up to that high growth period in March last year, we were about 50-50 on the gender, 50-50 male versus female. Now we're slightly higher to the male side, so we're about 60-40 on the investment platform. On the platform, average customer has about $4,000 invested on Sharesies, but our customers range from having cents or dollars invested to having millions of dollars invested on the platform. So we've got a really real range in there. I was going to use some of these stats a bit later, but we're also seeing a diverse customer base, but we'll dig into that when we talk about the gender and the different cultures that we see on Sharesies. But yeah, our average investment is our median investment through the platform is $370 for a single trade. For a mean investment is about $4,000. So again, that's tilted upwards by some really high investing. The average holding from a customer is about 3 ETFs and 4 companies. So again, we see a lot of diversification, and 7 of the top 10 funds by holdings by customer numbers are actually funds. So we see a real drive to funds from our customer base.
Awesome, thank you. Yeah, we will come in. And look, this is conversational, so panel, dive in if you want. We'll go to the floor as well, so if there are questions from the floor, just let us know that you want to ask a question. Rachel, I'm going to come to you on the educative part. Kind of how important is that stat around people engaging and learning and that, what was it, unjargoned or out-jargoned? Can you make comments on that piece?
Yeah, sure. Look, I think financial education and financial literacy is so important, and for me it's one of the biggest concerns when we look to digital platforms, because traditionally, people would have gone through that advisor channel, they've had somebody holding their hand, helping to explain some of these things, even if there was a lot of jargon involved potentially. And so then we look towards the digital world and taking out that human element, what are we actually doing to make sure that investors are understanding what they're investing into, understanding the risks involved, and learning and sort of upskilling themselves in terms of that financial education. I think it's really encouraging from this data that we are seeing really high numbers of people who are actually saying that they are, one of their drivers or one of their reasons for investing via digital platforms is that they're actually helping to upskill themselves in financial literacy. So what I can see from that, and it's really fantastic to see, is that there is actually obviously quite a big piece going on with those platform providers who are out there at the moment in terms of putting in the work and the effort to actually help educate people along the way. When you've gone to all the effort of building a digital platform and an investment platform, I don't think it's too hard to actually put those extra tools on top of that and overlay sort of the financial education piece. So I think we do need to make sure that that continues to sort of be, pretty critical in terms of the platform provider's point of view, because it is such an important driver for people when they're looking to do these investments.
Yeah, I suppose one thing that I've noticed at home really is, my youngest son was absolutely gutted to lose $1.23 on Tesla last week. And I think what this says really is that we can learn by doing for the first time, that these micro investment platforms have taken away the fixed cost of getting started. So, that's really, who learns by any other way than actually having a crack? And that's what people are doing, so fantastic. Now, the other thing that Gus mentioned is, that there is this core satellite approach, that people aren't throwing everything into GameStop. They are building a solid foundation first and then having a bit of fun on top. And it's really important that people do have fun, because that's where the excitement comes from, it's where the interest comes from. They'll do something probably sensible or near sensible with the 60% or more, but they will, but they'll have a go, in individual stocks or whatever on top. So, that fun component is also there in the micro investment platforms. It's important.
Fantastic. Let's get the blinds up.
I think I said the magic word, didn't I?
Yeah, I think so.
Fun.
Spooky. Hugh, you opened the door to the conversation which we had with Rob Everett from the FMA at the breakfast earlier this year, which was the GameStop Reddit piece, the ability to play markets, if you will. What's your sense of how that plays out? Like, what are the risks and the dangers that there could be a global piece around saying we want to long or short a particular stock and materially impact the market?
Yeah, there's always been power in I suppose, group activity and power to the people or whatever. So I don't think this is particularly new. There's that magic word again. However, I suppose markets need liquidity. You need a willing buyer and a willing seller. And if we are to get retail involvement in the market, there has to be something to buy and someone to buy from and someone to sell to. And so hedge funds and other contrarian investors are absolutely critical to the functioning of a market. But I would just warn everyone, and I think you all know this in this room, but it's clearly something to warn the general public about, is that these funds have access to the data, and we are not as rational or as unpredictable as we might like to think we are. And we all know that, but it's hard to put that into practice. So, you go and read stories about Renaissance technology or anyone else who's out there with access to data and analytics and algorithms, and they know what you're about to do. So you will get cleaned out, but if you're doing it with, a few bucks and you're learning about the markets, then that's a good thing. If you have a particular view of the world that you want to express through your portfolio and you're certain about it, then that's also a good thing. But, there will be someone disagreeing as well. And
So do you think GameStop was a one-off?
No, not at all. I think that was a whole new generation of investors learning something, and probably a whole new generation of hedge fund managers learning something too.
Ryan, you're nodding vigorously. Your comments on that?
Yeah, absolutely, and it's a market that's being disrupted, and people are learning, and there's power now of immediate action through social media. We're going to see it time and time again, and we have to understand that these things will happen.
Cool. I won't go there. I'll go somewhere else. I'll go to crypto.
Yeah.
So the question about crypto, right? So two questions. Is crypto the same as investing in, a slice of Tesla or a slice of Facebook, or is it fundamentally different? And how do you account for the 21% that came through in the data of people who are either in it or are thinking about getting in it?
Look, it's a new asset class. It's something that we all have to learn how it works. Hugh was talking about before about needing to understand things like liquidity, whether you can buy and sell it, who creates it, what's it made up of. If you don't understand those things, you probably shouldn't be investing in it. So I think there's a lot of education there. I think there are definitely cryptos are here to stay, and I think there's going to be a lot of good cryptos available. But it is buyer beware, and one of those things I was talking about before in my introduction is we need to see further regulation in this space. If you don't know and you want to get into crypto, then the probably best thing to do is to invest in a fund that invests in crypto, because you've got professional investors who are doing that on your behalf. But just beware that if you don't understand how it's made, and liquidity particularly, then you probably shouldn't be there.
Interesting, and I think your comments earlier on and then about the regulatory perimeter, which again echoes where Rob Everett was earlier in the year, where where is the fence, and what's the role when it's kind of cross-border and so on. So I think that's definitely one to pull out.
If you pull an analogy, I mean, many years ago you used to have markets, but then you also used to have independent markets that would run certain number of companies or whatever else, and there was a consolidation of those independents into a proper stock market. And the same thing with these currencies is lots of people trying to create a currency, and sooner or later there'll be a couple that are the tangible, the ones you invest in, and they'll be regulated. And it's just a matter of time before they become more mature.
Rachel.
Yeah, I think it's really important that we do bring up the conversation of cryptocurrency investment, though. As we've seen from the data here and the video earlier, there's a lot of interest around it, right? It's a pretty hot topic for people, especially younger people at the moment. And I think whereas going back a couple of years, a lot of the companies and investment houses here were quite reluctant to even start talking about it. I think we do need to be talking about it, and I think we need to be trying to do what we can to help educate people along this, because people are going to invest into it, and so we need to do something to actually help give some information across that's a little bit credible potentially, to actually help people along that investment journey, because they are going to invest in it. I think they're probably only going to do so more. So we just need to make sure that we're actually having that conversation and building the tools to help support that.
Rachel, just sticking with you, number of financial advisors in the room, and when a lot of these new tech platforms come in, huge numbers of people join them. What are the challenges for financial advisors if that's partly your market? Is it being disrupted, or does it actually run in parallel, do you think?
In terms of cryptocurrencies?
No, so probably more the original conversation around buying funds, buying ETFs, buying stocks.
Yeah, look, I think, there's so much knowledge and awareness out there now in terms of new technologies that are coming through, new investment assets that are coming through. And as a financial advisor, I think it's wise to embrace a lot of these things. I don't think it's necessarily always an either or. So if we look at robo-advice, for example, when we first sort of started hearing about robo-advice, I think there was a lot of worry from financial advisors that, this was going to come out, it was going to replace us, and what's going to happen now. I think what we're seeing actually in reality now is actually that, it's more of a hybrid approach. It's actually working better in the market, and we're seeing people and sort of both here in New Zealand and overseas switch to this more hybrid approach. Because there will always be a need for that personal touch point. There will always be, at some stage in people's lives, that need for a human connection. But I think advisors and other people in the industry can actually help to use some of these tools to support their own businesses and streamline some of those things themselves.
Hugh.
I mean, one of the surprises for me out of this research was just how negative people were on robo-advice, and I suppose, is that a question of branding, that it just sounds like scary, something scary coming through the door, or is it actually people don't like the idea fundamentally? It would be really interesting to dig into that a little bit further.
Gus, just to you, when someone comes onto the Sharesies platform and wants advice, so they're getting a lot of engagement, is there a facility in Sharesies to then segue to talk to someone, or to get guidance, or to go outside Sharesies to talk to someone?
Currently, Sharesies as a platform doesn't provide advice. We don't provide financial advice through to our customers. So we have an exemption to provide class advice, but we opt not to do that. Instead, we provide general informational advice. So we offer educational, like how to invest money, dollar cost averaging, diversification, invest only what you can afford to lose. So there's a lot of general advice. We provide a lot of information about all the products that we have on the platform, and we also provide risk categories about how risky and the type of time horizon that you should be thinking about when you're investing in a certain product. Do we point people elsewhere? We point people to sorry, I'm going to get these websites incorrect, but is it Money Matters, Sorted, where they can go elsewhere to find the advisors. We don't recommend anyone per se, so we sit as a neutral party in that space.
Cool. Rachel, I'm just going to take the segue you gave around the gender conversation about how it's different. So I'll go to you. The research has been pretty clear on it's kind of different for ages, it's also slightly different for genders. Do you want to maybe make some comments on how that plays out?
Yeah, definitely. I think it's probably not surprising to anyone here that men use micro-investing platforms more than women. They're more likely to use them anyway, as well as new and emerging technologies like cryptocurrencies and NFTs as well. What I find quite interesting are the reasons why men and women use micro-investing platforms. It's a little bit different. So we found that men are more likely to use platforms like Sharesies, Hatch, for the fun factor and because they're easy to use. Women are more likely to use these platforms as a way to improve their financial knowledge and their capabilities. So I think what we're seeing in the research is that women are more likely to, I guess, want to use these platforms as a way to improve their financial literacy. And we also found that when we broke it down by age as well, I think older people were more likely to use these platforms as a learning curve as well, compared to younger generations that are sort of more wanting to hop on the bandwagon and have a bit of fun and a play with things.
Interesting. I might just change tone, and it was a question I was asked a couple of times by journos today, and that is this shift fundamental? Has COVID triggered it, and we're going to go back to wherever we were before? Or is this now the new normal, and in fact the growth curve, the trajectory, the willingness and the comfort level with people to invest this way is going to continue? Hugh, I might go to you first and then Gus to you if I can.
Well, I suppose it's hard to remember back before COVID sometimes, but these platforms did start. I suppose Sharesies and Invest Now were kicked off, I think, early 2017, if I recall, and they were picked up very quickly by early adopters. I suppose the thing that changed during COVID really was the move to the mainstream, and maybe that was accelerated by the market discontinuity and the kind of temptation to pick the bottom of the market. So you see, I think, the number of new account openings on the platforms just went through the roof in that COVID time. So certainly from our perspective, I mean, just from Smartshares numbers, as a manager, at the bottom of the dip, we were at 3.1 billion. Today we're at 5.8. So, that's our climb out. Now, less than half of that is market return, and in fact, significantly less than half. So a lot of new cash coming in, and a lot of that, one other platform, which I say Invest Now, maybe I can. We are 7 of the top 10 funds sold on that platform. I think you've said we're 4 of the top 10. So, people are not just buying individual stocks, but coming into funds as well.
Yeah, I totally agree with that. So in terms of and a lot of it has been returns based, but we were 300k this time last year, and now we're 1.4 billion, and a lot of that is steadily flows in. Currently, during COVID last year, we're seeing days where we were having several thousand customers coming through onto Sharesies, and we still see about 500 every day, so the word is still spreading, which is great. The other thing we see a lot with Sharesies is a lot of our customers just put in $5, $10, $30, $100 a week, so we see tens of thousands of customers are doing that every week, and that's an ongoing thing that we're not seeing disappearing. So is there a structural change? I'd say just the persistence of that would say that our investors are here to stay investing for the long term.
Nice, right.
Yeah, I see there's an evolution. I don't think it's going to be overnight, but I think it will be a quick move towards digital platforms, and that could be your direct-to-consumer platforms like your Sharesies and so forth, but also we'll see advisors using more and more platforms to be able to go service their clients too. And, that's an underserviced market here in NZ. I know from our perspective, we do a lot of work behind supporting funds, but we're also building or have built out significant capability around supporting wrap platforms from a custodial perspective and so forth, because the very nature of people starting to see balances in their KiwiSaver of $200,000 and above, they're going to want more control, to have personal control over that. Or when people are investing, they want to be able to build their own portfolio online. I know it's a discussion I'm having with a lot of our clients, the fund managers, who are saying, how do we evolve into that space? And we're working with a number of businesses who are doing that. So I definitely see the evolution happening, and I see it happening quickly.
Fantastic. Folks, there's two other areas I just want to cover off, mindful that it's the end of the day and there are drinks awaiting us. So I just want to pick up the security conversation. Rachel, I might start with you. It came through very strongly in the research around how confident and comfortable people feel about it. What's your lens on that? How worried should we be?
Yeah, I mean, security is a huge concern, and rightly so. I mean, we've only seen, significant jumps in cybersecurity attacks over the last year in particular. I think when it comes to security, there really needs to be a two-pronged approach. One of them is obviously a huge burden or sort of, capability or responsibility when it comes to security on the platform for providers themselves. But at the same time, there also needs to be a sort of responsibility from the end customer and end investors when it comes to security. Things like managing your passwords, updating your passwords frequently, using two-factor authentication if those types of tools are available. When we talk about the platform providers, security is not just a one-off set and forget approach. It's a continual monitoring, evolving. There's new loopholes and new sort of cyber threats coming out on a daily basis almost. So it's a matter of really sort of having in place that strategy around that security that's continually benchmarking against those new threats that are coming out.
Riss, your thoughts on this one? And the kind of differences in age and stage?
Yeah, well, I think overall security of privacy of personal information and all of those kinds of issues, they're the number one consideration for consumers. It tops everything else. So returns, convenience, ease of use, customer service, security comes first. So I think it's impossible to ignore. I think from the research we can see that men tend to be less concerned with the risks, or a bit more willing to, take the plunge. Women seem to be a little bit more, unsurprisingly, we've seen this in other research as well. A little bit more risk averse. So, and again, with age, we see that older demographics. Although that was an interesting thing with the research that I found is that actually COVID had less of an impact on the older generations. I think it was something like 86% of those aged over 60 felt that COVID impacted their investment decisions. And I thought that sort of plays to this whole idea of life experience, the older you are, the more ups and downs you've weathered, you've been through all these financial storms before, whereas we saw that, the younger generation, so under 40s, so that 18 to 29 and that 30 to 39 bracket were quite impacted by COVID and more likely to switch to lower risk investments. So that's something that's quite interesting. So even though the older you are, maybe the less risky you want to be, but also the more risks you've probably taken in your life as well.
Awesome. So last question, we'll just whip around this one's completely unprepared, so it's completely raw. We're sitting here in 2021. In 2025, noting that we didn't see COVID coming, we didn't see the pickup as quick as it's been, where do you think we're going to be in relation to how New Zealanders think about digital financial services, online platform, and what's the next big disruption? I might go to Ryan first, just to perhaps have a crack, and we go random on this one.
Well, I think by the time 2025, 2026 comes around, digital platforms will be how 80% or more of Kiwis will be transacting in terms of their investments. So there's going to be the new platforms that come through, and there's going to be those that adopt the technologies into their businesses. So you'll be dealing, just like with your banks, you'll be dealing with your financial institutions and investments online. And you'll have a much greater ability to choose from different types of products. And those products, because we'll be collecting much more data from you and how you as an individual and people like you invest, will be tailoring products to you specifically. So there'll be a lot more around personalisation of financial product. So that sort of digital personalisation piece. And your advisor or your platform will know much more about you than you probably know about yourself when it comes to investments. And they'll be selling that data to other people.
Fantastic. Thank you, Ryan. Rachel?
Yeah, look, for me, I guess there's a few things that come through there. I think cryptocurrencies will only continue to grow and become more of a mainstream asset, no matter what our individual thoughts are about that. I think there's just too much interest and hype there, especially from the younger generation, for that to go away. I think over the last sort of year or so, we've seen a huge big push on sustainable investment and sort of down that track. And I think that's only going to continue to grow and to continue to explode. especially again in that younger generation who are coming through and who are sort of got some pretty big buying power these days. And lastly, I agree with what Ryan said in terms of mass personalisation. I think machine learning, AI, and digital platforms will become more of the norm, and that we will see mass personalisation across those platforms to sort of like a really sort of uber degree.
Fantastic. Hugh?
Yeah, I suppose the cryptocurrency digital asset space, I would say is, I mean, I think Rachel characterised it as maybe a bit of hype, but I would say it's really a trust question, and we're going to see digital assets becoming a much bigger part of society, particularly in areas where sections of society are losing trust in institutions. So that may not happen quickly in New Zealand because we're a high trust society, but in places where you don't trust the central bank, you don't trust the currency, you don't trust the land registry, then you are going to end up trusting a token instead. So that's going to be taking off, and it's the technology. It's not Bitcoin, it's the technology itself. So that's going to go. I think the other thing I'd say is that this disruption is only just beginning. Gus is still writing his notes on his wrist, and he's the we've got a long way to go before digitisation is over.
I was going to say with a borrowed pen.
Gus, I'm going to come to you last. Thank you, Hugh. Trusting the token. Riz?
I think from a consumer perspective, being of this generation that is priced out and jargoned out, for me, I think, I look at property prices being what they are. I look at interest rates being what they are. And I think I could just, I could save up for a house deposit, or I could throw $20 every time I get paid into my Sharesies account. And it's, it's fun, it's accessible. I learn something while I'm doing it. And I think that I'm not alone in that sentiment. I think a lot of people of my generation, and that, the water's flying, the younger generations, I think, are really driving this change and this adoption of new technology. And I think that coupled with the fact that here in New Zealand we are being sort of priced out of the property market, we're looking for other options. We're looking for options that are accessible, that are easy to use, that break things down for us, but not in a patronising way. Just, we want to have fun and we want to learn. And I think that, it's just the beginning, and particularly with cryptocurrencies, there's a lot of growth potential there. The research shows that there are more people who plan to use it than who actually currently use, invest in crypto. So the potential's there. The reasons for that, it could be, like we mentioned before, the trust factor. Maybe we just need to educate consumers a little bit more to get them investing in things like that. But I think big things are coming.
Thank you, Riz. And Gus, last word to you.
I think in 20 years' time, we're going to see a lot of customer-centric businesses and technology become more and more prominent. And I think this will be enabled by the technologies that Hugh's talking about here, and that will enable us to really trust, and we'll know that we're investing in what we believe in, and there's transparency around that. I think also the thing that we're going to see, it's interesting with the property price piece there, is I think our technology is going to solve a lot of the barriers to a lot of these different types of opportunities, which is going to be a real true democratization of space. And I think I'm going to bring it back in the short term of 5 years. I look at ways that people store their wealth, like super in New Zealand. I see structural changes to how super is, or KiwiSaver is for Kiwis. Lots of change to come, which is very exciting.
Fantastic. Well, luckily we've captured all of those insights, and we'll come back in 4 years' time and check them all out. Folks, just in closing, big thank you to the panel. Fantastic insights. So on behalf of all of us here, a big thank you. Again, to T, our research partner, to the FSC team who wrote, Riz and David, to EY for the hosting. Folks, enjoy your evening. Please join us for a glass of wine and a good debrief and a good chat. And appreciate you taking the time out of your day to join us this afternoon. Thanks very much.